All right. Hey, what's going on, YouTube? This is Aaron Yoon coming at you from New York City, and happy Friday. We are doing what I've been promising that we've been doing today, which is that we're going to review the week as performed. We're going to review the week in the stock market as it relates to my favorite app for beginners for trading in the stock market, which is iFlip. If you're not already familiar with this app, then the real fast recap of this is that unlike the other trading apps out there like Webull or Robinhood out there where you have to do everything manually, this does it automatically. So think of it like driving, right? Um, when you first learned to drive, there was probably a little bit of a learning curve. But nowadays, if you're learning to drive, you're like a high school teenager that's learning to, that is of that, driving permit age. You don't necessarily need to learn. In fact, I think the statistics show that people are getting their licenses. There's like a decreasing number of high school students and young people getting their licenses because the advent of like Uber and Lyft and all these rideshare apps where you get to be driven around, right? You just enter where you want to go, pay a little bit of money, and oftentimes that actually is a money saver. Then it's cheaper than actually having a car. Just pay a few bucks per ride, right? So technology has changed driving and transportation in a crazy way in the past few years, and now it's doing the same thing in the stock market investing world. Instead of figuring out when to buy, what to buy, how much to buy, when to sell, should I even sell, like all these questions, instead of trying to figure it out yourself, this app does it all for you. Okay, so that being said, today is a video on reviewing one of the SMARTFOLIOs. Now, if you want to go into manual mode and treat this like a Robinhood or a Webull or whatever, you absolutely can manually trade. You're not limited to AI only, but it gives you that bonus of AI investing, automated investing. So what you see here right now, this is my live account, by the way. This isn't a demo. I actually have, a little bit under $5,000 in here. And just to be absolutely clear, this is real cash, but the way you tell the difference between what I'm trading manually, well, these are the stocks that I'm holding manually, in the white over here, and in the blue over here are the AI SMARTFOLIOs. They're not portfolios, they're SMARTFOLIOs because they're algorithmically managed. Okay. So with that being said, today we're going to be reviewing the SPY. It's the one that I've talked about probably the least, and it's probably earned its due. So the first thing we're going to look at when we click on the SPY, sometime I gotta just refresh here. I don't know if it's my browser or it's probably my browser where like it doesn't load up the charts sometimes. My mobile has no problem with it, but my browser is not currently the best. Anyway, so I load this up, and let's take a look at its lifetime performance. It's not great. I'm going to be honest with you. It's not great, but there's a reason and purpose for that, and it is actually fulfilling its purpose. So let me explain. First, let's look at when this thing started. I actually had how much did I have in here? Like $600, I guess. Okay, so I had $600 in here all the way back in March when it first came out. And back in March, the SPY was not what it is today. There was a selection of stocks in there that I actually highly questioned. I was like, I don't really like these stocks personally, but to be able to do videos like this, I put some money into it, and I was just like, I'm just gonna kind of think about it as a little bit of a business expense write-off kind of thing, even though it's not, right? I'm just gonna mentally be okay with it and put money in it, and just let the AI do its thing. And sure enough, after it adjusted for the COVID crash, it changed the stocks that it wanted to pick in. It changed the stocks that it wanted to invest in. So that's the thing about this AI app. It actually addresses the question, which stocks should I be buying right now? And each SMARTFOLIO has a different set of investing styles and strategies. So obviously, based on this graph, it doesn't look very impressive. It certainly doesn't look like the SPY Plus, which is going up and up and up and up and up and up. That's made for growth. This one is not necessarily made for growth. It's made for something else, and I'm about to get into that in a second. But the important thing that I wanted to share with you during the beginning of this timeline is, yeah, while it went down, it was actually invested in a set of stocks. There were some like casino stocks in there. It just really made no sense for this to be invested in that. And then automatically it adjusted. It sold all those stocks, threw it away, and then bought new ones. And let me show you that in the history, and then I'll show you why it did that, as I promised. Okay, so let's scroll down to the history, and let's scroll all the way back. So in March, I put in $150. That's what I started with. That was the minimum investment to actually get the SMARTFOLIO to work. So, and like I said, I was not a big fan of these stocks, so I was like, I don't really want to put more than the minimum. I don't even really remember what these are right now. Let's see, if I were to CNTY, my guess is that something like a casino stock? Century Casinos, okay? Let's look at their year-to-date performance. Let me bring over Google Chrome. Okay, in a different, okay, so this is CNTY. You can see, they felt the COVID crash in full force, and they still have not fully recovered. Okay, not really surprising when you put two and two together and think of it as a casino stock, right? So I'm like, casino stock in March? That doesn't really make sense. What is this? I believe this is Nokia. Yeah, this is Nokia. Also, if we look at Nokia year to date, Nokia recovered. It was doing well, and last month, right? It had moved above its previous highs, but then it didn't do so well. But anyway, if you're looking at Nokia in the middle of the COVID pandemic, you're like, I don't know why you would have Nokia in there. For a dividend, maybe? I'm not really sure, right? And this other one, CLOU, I don't even really remember what these stocks are. I'm not a big stock trader, that's the thing. So like these things don't really ring a bell. There's so many stocks, it's hard to keep track of all of them. So this is on the NASDAQ, something with cloud computing, like, okay, whatever. Like I'm not really familiar with the company. And MFA, which is it's a finance company. MFA Financial. So MFA Financial never really recovered at all, right? They didn't do so hot at all. So you can see this had some problems. It was not a very good, and the SPY G is just a small section of the S&P 500 that is primarily for growth. Okay, so you can see that this kind of portfolio, this kind of selection of stocks, watch lists as traders call them, doesn't really inspire too much confidence. And so I was like, what is going on here? And I guess it was a little bit late. It was just a little bit late to the party, but it did adjust itself and it threw everything away. And in the beginning of April, it did change to what it looks like today. Let me just go back, because like that view doesn't show. Okay, I went far back. I went a little bit too far back. Now it's holding these stocks. Carnival Cruise Line, Bank of America, Chef, which is a food delivery or like a it's a is it for restaurants? It delivers food to either restaurants or to individual homes. I forget. But again, I'm not a big stock trader, so I don't know all the stocks. Okay. We have the SPY-G again, which is the growth section of the S&P 500, ExxonMobil, and AT&T. Okay, this set of stocks makes way more sense. It was it was a little bit late to the party, and it didn't adjust itself until April, but it did automatically adjust itself. Unlike a human, especially a novice, a newbie trader would think like, should I, shouldn't I? Let me ask some Facebook groups here. Should I, shouldn't I? What would you do? And by the time you get enough, you poll enough opinions on the internet, when your friends and family, markets already have moved. Right, and so you're like, okay, now you have to ask the question again. Well, it moved up or down now, so should I sell? Should I not sell? Should I hold? Should I wait? That endless cycle of questions and never getting any answers, and the torment, all that goes away because the AI can just do it for you. Now, is it perfect? Absolutely not. Nothing is, but it saves you the stress. To me, that's everything, right? My mental and emotional capital is way more valuable than a few bucks, right? Because that's my health we're talking about. So I mean, just running through real quick, you can see that there's a lot of red numbers. It did take a hit here and there. It did sell Carnival for a little bit of a profit. And overall, it is down. Okay, so let's go back to, okay, no, hold on. Okay, let's go back to this, the history, the more recent history, and you'll see the same thing like in May 26th and May 27th. It was thinking about buying Carnival Cruise Line, and then it didn't because the price movement was too extreme. It must have either gone up or down way too much. Let's take a look. Let's take a look at the past 6 months, and we're looking at the date of May. Again, this is everything nothing I'm doing is anything you need to have like a degree or a rocket science, like you need a rocket science degree for, like anything. This is all, you can Google all of this. So it wanted to buy, but I guess it had moved too much for it, and it got nervous, right? I mean, it didn't. AI doesn't actually get nervous, but it determined that, you know what, it moved up a little bit too much, and it didn't make sense. Okay, so it didn't buy it. You don't have to make the decision because the computer is making the decision. So. Hang on a second. Let me just take care of something here. So again, you don't have to make the decision. The computer makes the decision for you. Same thing with Bank of America. It was thinking about buying it, but it then pulled the trigger and said, you know what, never mind, right? It stepped back, right, and didn't buy. But it ended up buying actually on June 8th. Now let's take a look at June 8th. I bet you that was a bad day to buy, to be honest. Let's take a look at this. Okay, this this stock, Bank of America, over the past 6 months, June 8th was, yeah, a bad day to buy. But hey, this is just proof that the AI is not perfect. It's not going to time things perfectly. Although I will say this. Like I said, I was going to talk about before. This portfolio is not designed for, like, it's not designed for your balance to start growing and going up. It's not what it's designed for. Okay. You might be thinking, then what the hell is it for? Like, if you're not investing for your stock market price, for your stock balance, your wealth to go up, then what the hell are you investing for? That sounds silly, right? Well, let's get to the big reveal, and I'll zoom in a little bit too. SPY is a collection of well-known stocks that have sold off drastically as a result of the coronavirus decline in the spring of 2020. For investors who can look at a year or two out, this collection represents an opportunity to double while the risk about to double. I don't like the grammar here. To double while the risk is about half of capital allocated, i.e., 2-to-1 risk reward to risk ratio. That's terrible sentence structure, but I know what it's intending to say, and I'm going to explain. Let me just get through this. The construction and reward risk ratio is based on a dollar-weighted index that runs behind the scenes to allocate capital in the proportions necessary for the index, your investment, to attempt to double. At least they ended with the most important piece, the most important phrase is you're attempting to double. Okay? Now, if you're looking for, like, the average investor, and I did a whole video on this before, but the average investor, that's a novice investor, is looking for, like, hey, I want my, and I had this conversation. I actually had this conversation the other day with a client who wanted to just catch up, and I wanted to share with her how well she was doing. She was not invested in this, by the way. She was invested in a different SMARTFOLIO, one that was doing like 30% for the year. And I told her, hey, you're doing like 30% for the year. What do you think about that? She's like, I guess that's good, right? She has no frame of reference. And I was like, okay, well, what would you think is bad, right? Obviously negative is bad, but like what positive number as a return for this year would you think is not very good, not very satisfactory? And she goes, I don't know, I guess anything below 10. Now, I think that's, to me, it says a lot, because I think the average person is programmed to think, hey, like, I want to see something like 10% per year, because you hear that kind of figure thrown around all the time. Average, stock market on average returns you about 10% per year, 9.5% per year, 8% depending on, you know, who you're asking about, like what frame of window you're looking at, like what frame of time you're actually looking at it, whatever. Now, what if you could go chop around between, like, you know, 0 and like -5 or 10 or whatever this thing is right now? Let's take a look. Take a look all the time. It's -1.6% right now. It was as high as 20, but 27 in the height of June, when everything was like going nuts, and then it took a sharp nosedive down. What if you're just hanging around, you know, jumping out? Yeah, you could have taken some profit here, and I think it did, but nothing too significant. And just hanging around here. But then a year from now, you close your eyes, you go to sleep, and then you turn a blind eye to it. But then a year from now, you're at 100%. Is that worth it? Right? Could you handle the patience? Could you handle the amount that you have to wait for a year or two out? You'll get nothing. It'll just bounce around for a little bit. But in about maybe a year, like 12 to 24 months, you have a pretty decent chance. You have a 2-to-1 chance of doubling your money. What that means is it is more likely for my, I guess, for like, what's my starting balance? If you add up all of my starting balances together, it adds up, excuse me. If you add up all of my starting balances together, all of my deposits, it adds up to a starting balance of 600. So I have, and again, this is like not a ton of money. This isn't going to make me rich or anything like that. This is just for demo purposes to demonstrate that this AI, how this AI is going to work for you. So if you want to make it, if you want to take it a little bit more seriously, then just add a couple of zeros. Imagine that it's 60,000 or 600,000, right? Not just 600. But imagine that you can handle pretty much your 600 or your 60,000, whatever, doing nothing for about 2 years, but then see that it's gone and it has doubled after 2 years. It is not going to do its traditional, okay, every year it's going to make 10-15%, 10-15%. It's not going to do that. It's not going to make your incremental gains. It's going to do nothing. And then when I'm going to assume that the turning point of this whole crazy recession pandemic type of situation is going to turn a corner when we get mass distribution of a vaccine that actually works, like, and it's not one of these like rumors or myths or whatever. When we turn a corner and things go back to normal, whatever the new normal turns out to be, it will and people are traveling again. New York City looks like New York again. The subway cars are jam-packed again. You know, no one's really afraid. The social distancing is not really a thing anymore because, you know, things are going back to normal. When that happens, and again, we don't know that that's ever going to happen, right? But when that happens, then a lot of these stocks will go back to their normal price, and this portfolio will have doubled. So things like Carnival, for example. Carnival's a cruise line. Let's take a look at the year. Oh. Okay, so in a year, so you can see that Carnival this is the drop back in February, March or so. And it has not really recovered because no one's really going on cruises right now. I know that I personally was actually booked to go on a cruise, a Carnival cruise next year. But I, like many other people, decided, because they were offering it, decided to ask for a refund because as of right now, I don't feel comfortable with that yet. And I think the vast majority of people feel the way that I do. And they're like, yeah, can I get my money back, please? I know I put a deposit down for that cruise, but I don't want to go anymore. Like, I really don't, like, I don't care if you're upgrading me for free or you're postponing the date or anything like that. I don't care about anything like that. I just kind of don't want to. Currently, my mind doesn't want to think about going on cruises right now. And I think the vast majority of people are feeling that. And so they're in a little bit of trouble. Now, are they on the verge of bankruptcy? I don't think so. They're in a little bit of trouble, but they're enough of a mainstream cruise line brand that they should be able to recover. And when they do, right, we're guessing a year from now, maybe 2 years from now, but it could be wrong. It could be 5 years from now. It could be 6 months from now. We don't really know. But when it goes back to its pre-COVID prices, you can see that this is poised to double or even triple just this one stock alone. So I'm not going to get into too deep a dive right now because this video would take way too long. But Carnival is just a really, really good example of that. You have Exxon. I'm just going to talk about Exxon and throw that into the mix because Exxon is slightly different. Exxon has, while it's a good bet, you can see, like, okay, I put in, you can see that while it has room to, let's see, what was this pre-COVID prices? Like 70, we'll call it 70. And right now it's at, come on. See, on the mobile, it's easier to track these things. It's at 35. So there's room for this to double, right? There's room for Carnival to triple. There's room for Exxon to double, right? So right now, we're still smack in the middle of this pandemic kind of thing. But so it feels like the past few months and the past short term, it feels like it kind of sucks. The SPY eye kind of sucks. But that's not the point. The bet that you're making is that, hey, the stocks in this collection, this watch list, this SMARTFOLIO, should have plenty of room to double or triple, assuming that life goes back to normal within a year or two. Maybe 3, maybe 4, who knows? Okay, so this portfolio is full of that, but the thing with Exxon that makes it, there's an extra advantage, is that it also pays you a dividend while you're holding it. This is a 10% dividend, if I'm not mistaken. Is that how they're calculating it? I think so. I'm not sure. Give me 1 second. Let's check. I want to say it's 10%. Yeah, the dividend is 10% on Exxon right now. I wish they said they actually put it in percent instead of a decimal. That really threw me off. But yeah, 0.1 is 10% as a decimal. So you're getting a 10% dividend on Exxon right now for holding it, right? So during the 2 years that you're allowing for it to recover, you're getting paid a dividend. It's kind of like Exxon is saying, hey, thanks for believing in us and not, and holding shares. They don't actually say that to you, but like that's kind of how I'm thinking about it, and that's kind of how I want you to think about it. Okay, the stock market is complicated enough without trying to throw in all these extra variables and technical terms. Think about it as a dividend is like a thank you tip. Okay, and some companies are willing to give you that and sacrifice the share price a little bit, right? So this has a mix of stocks that have room to double or triple when life goes back to normal, and it has a couple like Exxon, for example, that it's going to pay you dividends along the way. So you have to understand what its intention is before you look at a chart, because like a lot of people won't do this. They'll just let me zoom back out here so I get my full screen back. Let me go back here. They'll just look at the SPY all the time and be like, this thing sucks. This thing is trash. It's garbage. You can't think like that. There's a reason there's a description, and there's a reason it's called a SMARTFOLIO. It is exactly the kind of diversified, true diversification, and I know that diversification is a word that gets thrown around a lot. True diversification comes from being diversified in uncorrelated markets and strategies. Okay, so obviously we're not uncorrelated markets here. Everything here is the stock market, right? So that's not a way we diversify. We diversify with our thinking, with our strategy. So the SPY Plus is what normal people and what most people, it's like the bread and butter of what you would want to see. SPY, that's not right. The SPY Plus is, I don't know what's going on here with my browser, but the SPY Plus is more of the kind of growth that you want to see, 10, 20% per year or more. Right now I'm doing 30% for the year on the SPY Plus, despite the recent correction, right? It was at 40 something for a year and it dropped down to like 30 something. Let me just refresh this. But the SPY is not designed to do that. It's designed to like just kind of wait and wait and wait and then allow life to go back to normal and then double. So you're still looking at gains, you're just looking at it at a different speed and getting there in a different way. So yeah, here's the this thing is getting confused and saying the wrong thing. Okay, so the SPY Plus. So right now I'm at 30% for the year. Okay, even after this drop down last week. So before I was at its high, I was at, come on, track it, at 45% per year, just like I said before. It's at 45. It dropped down to 30. It's being a little bit loose now because it has some. It has a lot of profits to work with, right? This is the kind of growth curve that people want to see. This is a year. You look at this and you're like, this doesn't look like there was a COVID crash. It looks like there was more significant of a dip, more recently, but I don't really see a COVID crash. Was this small thing the COVID crash? Where is it, right? It timed the market perfectly the way that most people would expect. SPY is not designed for that. It's designed for stocks to just kind of lay dormant for a little bit, until life picks up again, and then it has plenty of room to double or triple. at low risk. Okay, I know that Tesla is one of those high volatility stocks that people are obsessed with right now, and that had room to, you know, double and triple and whatever, just because it's just chopping back and forth a lot. That's more risky because it's moving up and down faster. It's moving more up and more down at a faster rate. That's just a recipe for risk. This app is designed to minimize risk, and SPY I is a SMARTFOLIO that's designed to do exactly that. Hope that made sense. If you have any questions, or you have any comments about, you know, whether you like it or dislike it, leave a comment below and I'll get to it. I'm pretty good about answering any questions right now because my channel is small enough that I can actually give individual attention, so feel free to reach out. But until then, everybody have a great weekend and stay tuned from the next video from YouTube.